Jerome Powell, the chairman of the Federal Reserve, came out and gave a speech at Jackson Hole just a few days ago. Now, I covered it on this channel at the time, and we spoke about its implication for the stock market, and in short, we said that it was very bad. Since then, the S&P 500 has fallen by 6% over just the course of a few days, and it's now down over 8% from its recent highs. That represents about $3 trillion worth of losses in the stock market, but unfortunately, the implications of this speech that Powell gave do not stop there. What he said will also massively impact the housing market in America. Jerome Powell basically just threw a lit match onto a gasoline-laden fire, and we all just happened to be watching it in real time. Today, we're going to go over exactly what was said, what he meant by it, what it means for housing, and why so many people are suddenly worrying. Now, in Powell's speech, he mostly started off by talking about the economy, about the markets, and about interest rates in general. He established how they are a tool used by the Federal Reserve, used to move the economy in the direction they want. And to put things very simply, at the moment, inflation is the biggest threat to the economy, so the Fed is using interest rates to try and bring inflation down. In order for that to happen, the economy also needs to slow down, and that's what the Fed has been doing over the first half of 2022. Now, Powell then spent a bunch of time justifying his actions, both the things he's already done this year and also the things he plans to do. He explained that inflation hits the poorest people in society the hardest, which is true. He explained that inflation is simply way too high and that it will destroy the economy on its own if we don't tackle it properly. He also mentioned how in the past, there was sort of a debate about, firstly, whether or not the Federal Reserve even can use interest rates to affect inflation, and then secondly, whether or not they should. And then he also made it clear that he thinks the matter is entirely settled, that the Fed can and should and does influence the markets, the economy, and inflation using interest rates. Then he went on to say this.
Inflation is running well above 2%, and high inflation has continued to spread through the economy. While the lower inflation readings for July are certainly welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25% to 2.5%, which is in the summary of economic projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates of longer run neutral are not a place to pause or stop.
Basically, he said that interest rate hikes will continue to be here and they will become the norm for the minimum of the rest of 2022. And after that, once they've reached that high, they will remain high for a minimum of about another year until the end of 2023. He made it very clear, a high interest rate environment is here and there's just no way around it. Now, why is this so bad for the housing markets though? Well, it will basically impact the markets in two separate ways. Firstly, it will impact demand for normal people buying homes, and then secondly, it will impact demand for investors buying homes. We'll start then with normal people. Very simply, higher interest rates means that mortgages get more expensive. To get a $300,000 mortgage, that used to cost maybe $1,300 a month back in early 2021. Today though, with mortgage rates of 5 or even 6%, as you can see from this graph behind me, that monthly cost is going to be closer to $1,800 or $1,900 a month. In another year's time, once future rate hikes take place and are here, mortgage rates will likely be sitting at something like 8%, and so the monthly cost of a $300,000 mortgage could be in excess of $2,200, almost twice what it was just a year ago. The pool of people who can afford a $300,000 home will basically be cut in half. The same will also be said for the people who can afford a $500,000 home, a $100,000 home, and $1 million home, and so on. That same amount of money that you earn will plain and simple buy you less of a home than it would in the past. Now, this effect, though, has already started because mortgages have already started to get more expensive. Pending home sales in the US across June were 20% lower than they were a year prior. That's 20% less, fewer transactions happening every month, because people are not able to buy with higher interest rates anymore. There are also, of course, a few other things going on. House prices absolutely skyrocketed over the last 2 years, and everyone knows it. If you owned a home during that period, then great, you are richer than you were before. And if not, if you didn't own a home, well, that sucks, and now buying a home is even more out of reach than ever before. The problem is, though, that home used to cost about $300,000 before the pandemic, and now it costs around $500,000. People owning that home aren't making 60% more money each month, though, and the buyers in that neighborhood aren't making 60% more each month either. They just had access to incredibly cheap mortgage rates. Now that rates have risen and are going to continue to risen, the demand levels required to maintain those house prices will simply not be met, so house prices will fall. It's also hard to ignore the fact that the economy is just weaker today than it was a year ago. Loads of companies have now entirely stopped their hiring processes, and even more companies have gone out and fired loads of staff, with some industries being particularly notable with this. Tech companies have had an awful year so far, with hundreds of thousands of layoffs and hundreds of thousands more to come. Massive companies like Snapchat are firing 20% of their staff overnight. This news about Snapchat literally only came out yesterday, but hundreds of other companies are doing the exact same thing. This reduces the potential number of home buyers, it reduces demand for those homes, and so it will cause house prices to fall. But that leads me on to the second massive problem with what Powell had to say. Even if there were no effects on the housing market from normal people, there are still massive problems at hand. We are, of course, here talking about investors, institutions, corporations, pension funds, and Wall Street banks. Now, these investors have obviously contributed to soaring house prices as well over recent years, as right now across the United States, 24% of the homes sold go to investors and not normal people. That is a massive chunk of the housing market, and it's almost twice as much as we used to have before the pandemic. The problem is, these investors are also dependent on mortgage rates, and almost all investor purchases are actually financed. Yes, they often do buy these homes outright in cash, but then they go on to leverage them afterwards with debt. For investors, mortgage rates are more important than normal people though, because a normal person's aim when they buy a home is simply to live in it. So if they can afford it and they like it and they want to live there, then everything's fine and the goal is accomplished. With investors though, the only goal is to profit. So when rates rise and rents don't cover those costs anymore, investors stop buying everything. And why would they buy anything when it loses the money? Now, the important numbers here are cap rates compared to mortgage interest rates. And a cap rate is basically just the rate of return of an investment. If you buy a house for $100,000, then how much profit is it expected to provide to you after costs to maintain, repair, and make up for vacancies and things like that? Now, if the cap rate is above the mortgage interest rate, then every penny of your debt gives you an extra bit of profit. If, however, the cap rate is lower than mortgage interest rates, then every penny of debt you have means you lose more money. We are quickly approaching a time where cap rates will be lower than mortgage rates, and that will be massive. When that happens, investors will instantly stop buying property because it will simply not be a good financial decision. We are already seeing it happen in certain areas with some of the big boys in the market. Home Partners, who you can see an article behind me here about them, they're a company that buys single family homes, and they've stopped buying homes in 38 different markets completely already. Now, who owns Home Partners? Well, none other than Blackstone, one of the biggest, most powerful corporations of all time, and a massive player in the US housing market. When this investor demand disappears, 24% of home buyers will disappear too. That means fewer people considering buying each house for sale, no more bidding wars, no more houses selling for over asking, and house prices will fall as a result of it. There's simply no way around it. Ultimately, all of this will happen because of what Jerome Powell just said at Jackson Hole. He made it clear that rates will go higher, not lower, and then they will stay high too. Inflation needs to be destroyed, and if the housing market needs to die to achieve that aim, then he says so be it. What should we really expect then? Well, a long period of falling or stagnant house prices. REITs could struggle too, and many other type of institutional investors as well. This will, though, be a very long and slow process. People always expect a trigger or some kind of instant crash, and that almost never happens. Housing crashes take on average 3 or more years to play out in their entirety, and even stock market crashes, which most people think of as instant, usually take more than a year. If you bought a house though, just live in it because that is what they're ultimately for. You can wait the crash out, and in the long run, you will probably be fine. If you bought a property as an investment and you see it going down in value, well, it's a tough lesson to learn, but that lesson has to be learned. Every kind of investment can and will lose you money at some point in your life. There is, of course, a silver lining here as well. investors and corporations getting hurt and leaving the market isn't necessarily a bad thing. There are millions of people who have been priced out of ever owning their own home, and seeing prices fall will be very sweet for those people who will finally find them within reach once more.